Hello and welcome back to the Microlearning Institute. In this tutorial we look at how to consolidate a foreign subsidiary in line with the rules of IAS 21. So here, for this example, we assume that the dollar is the functional currency of company A, and also that the dollar is the presentation currency of the group. We also now assume that the euro is the functional currency of the foreign subsidiary B. Now the question states that on the 1st of the 1st 20x1, company A paid $60,000 to acquire 75% of B, when B's only assets were cash of €1,000 and a machine at €9,000. And on that date of acquisition, $8 was equivalent to €1. So the first thing we do is we look at what goodwill arose on the acquisition of B by A. Now, the fact that we bought B's net assets and that B's net assets were valued in euros suggests that we measure the goodwill in B in euros. So, in terms of cost, we paid $60,000. The exchange rate at the date of acquisition was $8 equals €1. So consequently, we paid €7,500 to acquire our 75% share in company B. We of course now need to compare that with our share of the fair value of the net assets of B, and we're told in the question that the only net assets in B at the date of acquisition were a machine valued at €9,000 and cash of €1,000. So the total fair value of net assets in all of B at the date of acquisition was €10,000. We acquired a share of 75% of those fair value of net assets. So consequently, we acquired €7,500 in fair value net assets. So at goodwill, at acquisition, we can see that there was no goodwill generated at acquisition in this example. Next up, we begin to look at how we can consolidate the foreign subsidiary at year end, the 31st of the 12th, year 1. Now, let's look at the exchange rates that are prevalent in the year. The exchange rate at acquisition, we've just been told, is that $8 was equivalent to €1. The average exchange rate for the year since acquisition was $7.50 is equivalent to €1. And at year end, the date at which we're preparing the consolidated statement of financial position, the exchange rate is $7 is equivalent to €1. So here we show the draft statements of financial position of A and later of B at the date of consolidation at the 31st of the 12th x1. So here's the statement of financial position of B. Now let's look at A. Okay, we have a machine at €6,000. Now you'll remember at acquisition the machine was worth €9,000, so the machine has been depreciated by €3,000 since acquisition. We also have cash on the statement of financial position of B of €9,000, and again you may remember that the cash was only €1,000 at acquisition. So we have a total assets in euros on the statement of financial position of B of €15,000. That's matched with ordinary share capital and opening retained earnings of 1 and 9. Now that's the total net assets that were in place at acquisition of 10. You may remember they equated to $9,000 or €9,000 for a machine and €1,000 in cash. Now, since the acquisition, we have also, or B has also made profit of €5,000 in the year. So consequently, the closing liabilities and equity is also €15,000. Now, the first working we need to do in order to translate a foreign subsidiary is to translate the net assets of B. Now the structure for this working is as follows, and we recognize that the opening net assets in euros of B were €10,000. You recall from the previous slide that we made a profit in the year since acquisition of €5,000, and of course consequently from the statement of financial position the closing net assets of B were €15,000. Now, we need to translate each of those elements at the appropriate rate. Now, the opening net assets are translated at the rate that was relevant on the date of acquisition in this case, and therefore the €10,000 translates to $80,000. The profit for the year is translated at the average rate, and the average rate we saw from the table is 7.5 So therefore, the profit of 5,000 euros translates to $37,500. Now, we would expect then in dollars that if the opening net assets were 80,000 and the profit was 37,500, that the closing net assets in dollars should be $117,500. However, when we translate the closing net assets at the closing rate, and of course the closing rate at the date of consolidation is 7, they translate to only $105,000. So what we anticipated would translate to $117,500 translated to only $105,000. So consequently, we've made an exchange loss on the translation of net assets, and that exchange loss is the difference between $117,500 and $105,000. So that exchange loss on translation is $12,500. Now, in terms of the treatment for that exchange loss, that's taken to other comprehensive income in line with IAS 21. And of course, the $37,500 of profit is taken to P&L. Next, we can now prepare the consolidated reserves. So in order to prepare the consolidated reserves, we need to understand what are the post-acquisition reserves in dollars of Company B. So we do this by translating the statement of financial position of Company B. You remember that we saw this statement of financial position in an earlier slide for Company B, but of course it was represented in euros. We now need to translate it to dollars. So the machine and the cash are translated at the rate that's relevant at the 31st of December X1, that's 7, and they translate to $42,000 and $63,000 respectively, giving us a total assets at the date of consolidation of $105,000. That, of course, will equal the total liabilities and owner's equity. Now, the ordinary share capital and the pre-acquisition reserves are translated at the rate at which they came into the consolidated statement of financial position. And of course, that was the rate at acquisition, which we recall was 8. So they translate to $8,000 and $72,000 respectively. So the post-acquisition reserves then translate, and they are a balancing figure. And that balancing figure is the difference between 72 plus 8, which is 80, and 105. So therefore, the balancing figure, which is the post-acquisition reserves of Company B in dollars, is $25,000. So now that we know the value for the post-acquisition reserves in dollars, we can now consolidate the reserves. And again, you remember the two balance sheets now. And again, I've highlighted in red here the reserves that we're going to be consolidating. We're going to be consolidating the 80,000 plus the 10,000 of A, because all of A's reserves in dollars get consolidated. And of course, the post-acquisition reserves of B, we're going to consolidate our share of those, which you remember is 75%. So let's look at that working. The reserves of A are consolidated in total, that's 90,000, and we add the group share post-acquisition in B, which of course is 75% of that $25,000, which equals $18,750. So the consolidated reserves of the group at the date of preparation of the consolidated statement of financial position is $108,750. Next working we can now look at is the working for non-controlling interest. And again, we recall that we, the group, purchased 75% of B, so therefore the non-controlling interest have an ownership stake of 25% of the fair value of the net assets. Now, we'll remember from a previous working that the closing net assets in euros were 15,000 euros, and of course the closing rate is 7. So the closing net assets of B in dollars is $105,000, and of course the non-controlling interest share, they're entitled to 25% of the fair value of the net assets of B in dollars. So consequently, our non-controlling interest is $26,250. Now we can prepare the consolidated statement of financial position. And again, we're looking at the two statements of financial position in dollars. We see there was a machine at $42,000 on Company B's statement of financial position, and that consolidates in full. Similarly, we've got cash on both the balance sheet of A and B, and of course we consolidate all of that because we, the group, are in control of all of that cash. so that consolidates to 93,100, meaning that we have a total assets on our consolidated statement of financial position of $135,100. On the other side of the balance sheet, the share capital we recognize is only the share capital of Company A. The retained earnings from our previous working is 108,750. The non-controlling interest value to the statement of financial position at date of consolidation, again from our previous working, is 26,250. So therefore, our total liabilities and owner's equity add to 135,100. And this again is our consolidated statement of financial position. We can now also take a look at the group statement of comprehensive income. And again, we recall from an earlier slide that we made $37,500 in profit in Company B, and also we had $12,500 of exchange loss on translation of the net assets. So the profit in A, we remember, is $10,000. The profit of B is $37,500 we've just seen. So the consolidated profit is the sum of the two at $47,500. And again, in addition to that, in other comprehensive income, we've got the exchange loss on translation of net assets at $12,500. So therefore, the total comprehensive income that's applicable to the consolidated statement of financial position at year end 31st to the 12th X2 is $35,000. Now we now need to share that profit and the other comprehensive income between the shareholders of the group and the shareholders of the non-controlling interest. So now let's look firstly at the profit allocation. So the profit figure we can see is $47,500, and now we need to share that. Now firstly, the non-controlling interests are entitled to their share of the profit after tax in Company B in dollars. So we can see that the profit after tax in Company B is $37,500 and the non-controlling interest share is 25%. So therefore the non-controlling interests are entitled to $9,375 of the total $47,500 of profit. And the owners of the parent then, of course, are entitled to all of the profit of A plus the holding companies, that is A's share of the profit of B, which is 75% of $37,500, and again that totals the $38,125. So there we have the split in this very simple example of the total profit of $47,500 split between the owners of the parent and the non-controlling interest. Finally, we want to look to see how do we allocate the other comprehensive income between the shareholders of the group and the non-controlling interest. And again, you remember that the other comprehensive income related to the exchange loss on the translation of net assets of $12,500. So again, we need to allocate it now. So the non-controlling interest are entitled to their share of that loss. So again, 25% of $12,500 is $3,125, and the owners of the parent are also entitled to their share, it being, of course, 75%. Thank you very much for looking at this short tutorial on the translation of foreign subsidiaries from the Microlearning Institute.